I'd like to quickly introduce and invite our set of speakers. First up, we have with us Shyamsunder, CEO, Navi Mutual Fund that has been founded by Sachin Bansal, and he's currently focused on growing its low-cost passive investment products. And joining him, we also have with us Rohit Shah, who in fact started the financial planning firm in 2012 and comes with more than 24 years of experience. He's a principal officer at GYR Financial Planners. We'd also like to invite our next speaker, Shravan Kumar Goyal, fund manager, UTI Mutual Fund, to please come on stage. And he's someone who comes with over 15 years of experience in risk management, equity research, and fund management as well. Our next speaker, ladies and gentlemen, we have with us Vivek Rege, founder and CEO, VR Wealth Advisors. And he has a functional experience as an investment advisor for over 18 years in the investment advisory industry. And with that, let me also invite our session moderator. We have with us none other than Prem, Khatri, the founder and CEO, Cafemutual. And ladies and gentlemen, let's also have a round of cheer to invite Prem. Because when he's not exploring interesting places around the globe, he's actually busy brainstorming ways to empower the distribution community in building stronger and resilient businesses. So with that, it's time to brainstorm again. I'm going to hand it over to you, Prem. Over to you then.
Okay. So good morning to you once again. And today we are going to be, right now, we're going to be talking about what are the challenges which hold back the growth of passives and what needs to be done about it. So by the end of this session, we should have a few pointers at least on what needs to be done. But first of all, for the last 3 or 4 years, we've seen a massively successful campaign run, which is the Mutual Fund Sahiye campaign. So now the message which needs to perhaps go out is passive fund Sahiye. Is that right? Would you agree on this panel? So how would you do that? So as a manufacturer, Hari, what would be your views on how do you make sure that the message now goes across that passive sahi hai? Yeah, keep it.
Thanks, Prem. And thank you to the Cafemutual team for setting up this conclave. I think the starting point is something like this, right? I think we have made a start here to send the message out that passive funds sahi hai. I think the numbers are speaking for themselves, as speaker after speaker have come up and shown through the power of numbers that the passives are delivering the performance which are good for the investors and the investing community. The question is to then convert this into the story and making this a part of every distributors, in every person who's touching an investor or a potential investor. I think that is the question, is how do you get to them? And I think a lot of the mutual fund base today is very new. So there's a process already of trying to move from, say, fixed deposit or the safety of banks to mutual funds and equity mutual funds I'll speak about. And that is a journey which is played by advisors, by distributors. So it's about creating the whole community. I think the message is about creating a wider message that the new investors who are coming in should look at passive funds as well as a starting point. That's one. And the second is for people who've already invested in active funds and maybe have a much larger allocation to active funds. Is there a role for passives to play in optimizing your portfolio? So that's the second way to think about it. So I think the combination of these and regular messaging. I think what worked in the Mutual Fund Sahiye campaign is regular, consistent messaging. I think that's what needs to be done here as well for passives.
Okay. Now, Shravan, as a manufacturer, you've done a tremendous job by telling people mutual fund sahi hai. How do you now tell them passive fund sahi hai?
Hello. So I would say a similar term can be coined for passive as well. So some of the people who are advocating passive funds, they say that mutual fund sahi hai, but passive could be better hai.
Okay.
Or similar terms could be coined for passive funds. And good part about passive is whatever, in the sense, investors are seeing, they will get that returns. So, जो दिखता है वो मिलता है. So, for example, if you are investing in Nifty-based index fund, so at the end of the year, your returns are going to be very close to Nifty-based index, right? So, the deviation from the benchmark is much lower for passive funds as compared to active fund. And I would say, in case of active funds, fund selection plays a very big role. And the consistency of active funds performing year after year is not that great. If you look at globally, about 70-80% of the actively managed funds are not able to beat the benchmark because markets have evolved globally. So as and when Indian markets evolve, a similar situation could arise wherein actively managed funds will find it difficult to beat the benchmark on consistent basis. So from overall wealth management perspective, I believe as a country or as a distributor, you should focus on combination of asset allocation as well as fund selection. You should not lose focus on asset allocation because asset allocation plays far bigger role in overall wealth creation as compared to fund selection or stock selection. So I believe that the passive funds, because it is easily understood, a roadside vendor, whenever you talk to them, they say that Sensex or Nifty is at 52,000 or 16, 17,000. So that is very well understood. So for a layman, small investor as well as HNI, it is very well understood. As a community, we should make efforts to create awareness about benefits of passive funds, and we believe that in the longer run, passive funds will play a very big role in overall wealth creation for the investors.
Okay, but ये messaging जो है ना होना है, इसमें the distributors, many of whom are present here today, play a very important role. But when I talk to some of them, I get a feeling that they believe they're still not convinced enough. They believe that India is a market for actives. They also believe that there is not enough remuneration which is available in passives. Is that right? Yes. Is that a correct belief? Now, I'll leave it to the two advisors here on the panel to share how it makes more sense, how there's a business case for passives.
Yeah. So I'll just take a step back, right? The question what you had asked.
Yeah.
So I think we first require a natural market.
Okay.
For passives, which is currently growing.
Okay. What is the natural market? Sorry.
So the general people who understand. So for example, when we say mutual fund sahi hai, okay, I think the sister campaign should be, passives bhi wahi hai.
Okay.
Okay, because from a investor's perspective, they are not able to differentiate between a mutual fund and then now somebody is going to talk about passive. So they feel like these are two different things, completely different things. So I think the campaign should be like passives bhi wahi hai. Correct? So I think if it's going to connect with the original campaign, it will help.
Yeah.
Sometimes even asking a question helps.
Yeah.
Okay. So for example, the younger crowd, if you look at, if you tell them what to do, they may not accept it. But if you ask a question, ye passive kya hai? If you leave with a question also, that triggers a curiosity. So I think the market is going from innovators who were very, very early people who started investing it. Then it moved to early adopters. Yeah. And now it is steadily going to early majority. Now, early majority, when we look at from a context of a Bharat lens, okay, mutual fund is also, I think we are in the early majority is yet to come. People are not yet fully invested. They don't know mutual fund also today, many times. So I think a lot of penetration has to be done. So instead of passing a kind of a confusing message, if we pass a message that passive bhi wahi hai, then it is far more acceptance rather than putting another new, kind of a concept which will take a few years for an investor to really know. Okay, so I think this is the first thing. The second thing is that from an investor point of view, it is important. Please understand that this is an information age. So before you reach the investor or the client would know things much ahead of time. And therefore, I think it is very important that from an image and a perception management also as a distributor, stroke advisor, whatever you may say, it is important that we are able to pass on the message to the investor rather than the investor passing the message to us. Okay? Because that is going to have a perception issue about, is my distributor lagging? And that perception can be very difficult to handle. I think once the perception is made, it will take a few years for us to correct it. So today, I think you have a runway to adjust and adopt based on what is happening around. Okay, so my message will be that more than anything else, we should just say that, can we reach the client first? Rather than the information age reaching the client first. And the client asking us a reverse question. I think that is a big issue.
That's a good point.
Yeah?
Yeah. But what would you tell these people who are here today on what is the business opportunity behind passives?
See, there are two things what an investor is asking essentially. Okay, one is give me a market rate of return, and second thing is beat the market rate of return. You are already making portfolios which are active portfolios. Okay, there is always a strong case to have something which is going to give them a market return at least. Okay, so at times it is very important to introduce the concept, even if it is not a core but even a satellite in the portfolio. It becomes important for them to see the line item in their portfolio. Once they see the line item in their portfolio valuation report, I think their acceptance is far better because they will start tracking that much more better. So I think there is definitely a strong case for adopting this early in time, including it, in the portfolios. And I'm more worried about the perception than anything else. See, business case automatically build up हो जाता है boss. आपके पास volume है तो business case बन जाएगा. Okay, but आपके पास client अगर नहीं है तो problem है business case बनना. So I think we cannot afford to lose a client just because a perception has been made कि my distributor or advisor is old age or industrial age. No. We are here. We know what we are doing, right? And we can talk the right things. Yeah?
Okay.
And I think that is a message as far as the business case is concerned.
Okay. Rohit, what do you have to say to Vivek? Vivek is saying that, look, this is an opportunity. You better talk about it first to your client before he starts talking to you about it. And he feels that there's a missed opportunity if you don't get into passives. Is that right? What do you have to say?
I think that's a fair comment, and I can see where Vivek's point is coming in terms of, building and maintaining a credibility as an advisor where you have a client-first approach. And I would slightly extend this argument and a viewpoint and say that the trend is very clearly visible for all of us to see. And, I think 2008 or 2009 is somewhere, I think the benchmark came up, and then it moved to Goldman Sachs and then the Nippon, and then if you can see the trend for the last 2-3 years, the number of fund houses and the number of actual funds and the schemes which have come up for the passive, that's very clearly a strong indicator. And I think one of the good approach for us as an advisor is to keep an open mind, always keep seeking disconfirming views. If I think passive is great, and if somebody is disagreeing on a Twitter expert saying why passive is bad and active is great, I'll pay a lot of attention to what this guy is saying. So, I think I agree with Vivek. The trend is very clearly here for us to see, and more importantly, we need to protect the credibility that we have built with the client, and kind of make sure that we maintain that perception, we maintain the delivery, that we know what's really happening, we know what are we doing. And, I have a slightly different view here, Prem. I feel that what we are talking about is all a security selection. And if you really look at in a larger things of scheme, a security selection is an advisor domain. The money belongs to you, the client, but the goals are a joint responsibility, right? So as an advisor, what we are going to do is, we are going to make sure that we educate the client. We're going to make sure that the clients are comfortable with, what we are doing. But we have to keep in mind that, this is an area that we are responsible for. The clients are not co-creating investment plan. We are creating that. We own it. So, before we tell the, how will we convince the client, we are ourselves convinced. And it's not a question about, passive sahi hai. It's a question about passive bhi sahi hai. Because the problem with this kind of communication is that it can be interpreted that passive hi sahi hai. So I think
So it is not active versus passive, it is active and passive together.
because it works differently for different people, right? We can't have one solution applicable for everyone, right?
Okay. But some rules of thumb from you on what proportion of active and passive should be there in investors. How do you decide that this investor needs more of active, this investor needs more of passive? How do you decide that?
So I think, generally satellite approach works very well. And, there's amount of the framework that each firm, each advisor uses. There's a methodology. Over a bit of time, you build a, kind of a modeling. And I think it's very commonly observed that there's not much of the benefit left in the, let's say, large cap kind of area where you could comfortably use some of these index funds and the passive funds. So, based upon, how you kind of build, because, what is the extent of equity you're giving to a client depends upon the risk profile, depends upon the goal situation, depends upon the, his comfort and ability. Again, you have to keep in mind that risk tolerance is different and risk capability is different. So, it's really different. It's each customized for each solution. But, you could look at some of the components and then kind of pick up that extent.
Okay. My next question is to Shravan, actually. One of the criticisms against ETFs particularly is that the markets are not so liquid and that there is very often a mispricing. So what are the manufacturers doing about it and what do you think needs to be done about it?
So globally, in case of ETF, entire volume is flowing through secondary market. So in the sense, both retail, HNI, institutional clients have to trade in ETFs through secondary markets. So there is no other mechanism. While in India, most of the institutional clients as well as HNIs or larger clients who can invest in multiples of basket, they have option to come through AMCs. So which means that they are creating or redeeming through AMCs and that particular volume is not flowing to the secondary market. So that is impacting liquidity in a big way from secondary market perspective. Second, the market making needs to improve. So currently, market making mechanism is very inefficient. So for example, currently, whenever any investor is buying ETF units on exchange, market maker is providing that liquidity by selling those units to the investor. And in turn, he is going to AMC for creating or subscribing for those units. Right? So here, whenever he is selling units in the secondary market, he will get money on T+2 basis because the settlement process in India is T+2. And whenever, in the sense, in turn, he is creating units through AMC, he has to pay money upfront. So there is a funding cost involved for market maker here. So although both the legs, in the sense, market maker providing or selling ETF units through secondary market as well as ETFs buying those underlying shares are guaranteed by clearing corporation. So both the legs could be netted off so that the funding requirement for market maker could go down substantially. At the same time, if this particular mechanism is adopted, in that case, market maker needs not hedge his position because he is going to execute both the legs of the transaction and this will be much more efficient and then bid-ask spread or spreads that we call whenever we deal in secondary market, that will reduce drastically and it will benefit retail investors in a big way. Although these challenges are not applicable in case of index fund because investment in index fund is just like investment in any other mutual fund scheme wherein you are investing at the cut-off time, before cut-off time and you are getting day and NAV. But the secondary market liquidity can be addressed by improving the market making mechanism and which is very much possible and I believe that industry is working in this regard with the regulator and my belief that sooner or later this particular problem will be addressed.
Okay. Hari, I have lots of questions to ask you. Sure. You launched a fund with the 6 paise cost structure. Do you think it's going to be viable to run a business like that?
Right. So I think that the point is to keep the customers first.
Yeah.
And we believe that passives are a massive opportunity in
Yep.
India. The target is towards that. I think if you build scale, then the viability will happen. Over time, we have seen most of the costs in the business start compress. I mean, if you think back to maybe a decade or two ago, the transaction costs, and this is true across the world, we have seen a lot of the costs involved in financial services fall over time. With scale as well, some of these get addressed. So I think that is the question. I think the point has got to be about looking at whether this is something which can be massively scaled up. And that's what we are trying to do here at Navi. I think so that is the direct answer to your question.
So how many products do you have in the pipeline?
That's something which I can't speak too much about. That is presumptive. So
Okay.
Until
But,
the
I mean, I checked on the SEBI website, there are quite a few funds which...
those have been filed, but I cannot speak about the new launches without the
Okay.
approval of the...
But will the other products also follow a similar pricing structure?
Yes, our approach is going to be low-cost passive investing.
Okay.
That is, I think this is at the heart of it. Some of the index funds we have launched are what we consider to be commodities. Commodities should be priced as such. So I think if there's no additional value, I'm going to put it that way, a special value which you're adding, then you should be pricing as such. I think that is our approach to passive investing. That is our approach to what our pricing also will be.
Okay. Do you have plans to launch ETFs as well, or is it going to be largely index funds?
No, I think that is, Sharwan has addressed a lot of the questions around ETFs, I think. But I think definitely one of the points which I may add to that discussion itself is that this is still new in India. We've just seen it grow, explode in the last 5 years. The maturity of this market, I think some of the liquidity will also come through. We've also seen at the same time retail adopting, we saw the numbers up on how retail has also adopted ETFs a lot more. And along with that, and we also seen an explosion in the number of demat accounts in the last 2 or 3 years, right? So I think some of these itself, and once these ETFs are seen as tools which can be used for the goals which you have got, whether it's more tactical or whether it's more strategic, some of these questions will be addressed on ETFs. So we do see a role for ETFs as well.
Okay. And given the cost structure that you have, how do you see the distributors getting involved with a fund house like Navi?
Right, so I think there are two different questions. Right? So I want to break them out separately, make it very, very clear. The cost of fund management is what's captured in the direct. The cost of distribution is in the difference between the regular and direct. Right? So they're two different, very, very different points. Distributors are a key part, and I said that they're the ones who are the first point of contact for many new investors, particularly, and they play a critical role in pushing forward the mutual fund industry. The role of advisors and distributors in that cannot be minimized. And I think, at least for the distributors, today there is a cap, which all of us play by for the index funds at least, that there is a 1% cap, you cannot go beyond that. And so to that extent, we are capped. I don't think that should be the case necessarily. If there's a cost of distribution which the distributors feel they have, and they require to be compensated for the value of that advice, then I think that should be given. But today we are tied a bit by the rules which we have to play by.
Okay, okay. But what are you doing on your part as a fund house to be creating more awareness for passives?
Right. I think that is. I think it's critical to. That's a critical part of it all. And what we are looking to do is create a lot more educative content around passives. But I think again it gets back to that. I mean, if a lot of the investors are new to mutual fund, a lot of our customer calling which we have done, speaking to customers, points out that this is still very, very new to many, many customers, particularly the retail customers. It's even the concept of mutual funds, as Vivek also said that the passive funds and mutual funds can be confused.
Yeah.
are passive funds mutual funds itself, or are they different things altogether, right? And so passive funds be mutual funds hai is something which is a point also which needs to be addressed. So first address what the mutual funds, create content around that itself, and also about index funds, to point out that this can be a one-stop shop. You don't need to hunt which is the best active fund. If you can start off with your index fund itself, you know what a Nifty is. The name familiarity, Nifty 50, everybody knows. The Sensex, everybody knows. The name familiarity is already there. So you can play on that. I think that is the way you can think about making this more friendly to the newer audiences.
So, Hari has made a very interesting point. He believes that the low cost of the funds that he's launched is because it is the nature of the product. He's implying that this is closer to a commodity. So how, as a fund house, do you deal with something like this, where cost, how do you tell people to look at your funds without necessarily looking at the cost?
Sure. So I believe cost is one element while selecting any passive funds. So apart from cost, you should look at some other elements such as tracking error of the fund, which shows the ability of the fund manager to replicate the benchmark, because that is also very essential, because your aim is to generate returns very close to the benchmark, and funds which are having lower tracking error have better ability to achieve that milestone. Second, size of the fund is also very important, especially in case of index fund, because typically inflow and outflow cost is borne by the fund in case of index fund. So a decent size fund with in the sense stable inflow outflow could deliver better returns to the investor in the longer run. And third, apart from tracking error, you should also look at relative performance of the fund vis-a-vis benchmark, which is typically called tracking difference. So because that is your end goal of achieving returns very close to the benchmark. So by looking at combination of these factors, you should select a particular fund. And coming back to the point on remuneration part, so I am a big fan of transparent business practices. So businesses which are transparent, they have higher chances of getting successful in the long run. And if passive funds are relevant for the investors for long-term wealth creation, then it is going to add value for mutual fund distributors from longer-term perspective as well. In the interim, your fee could be lower, but in the longer run, it could actually help you acquire clients in a big way, because new age investors are looking at simple solution at low cost. At the same time, whenever we look around, for example, there is unbundling of cost happening at various ends. For example, food delivery apps. Earlier, they were not charging for delivery. Now they started charging for delivery, and the relevant food delivery apps who are delivering on time and quality products, people are willing to pay for that. Similarly, airline industry is also going for unbundling of cost. So wherein, apart from seat, you have to pay for everything. Food, seat selection, or for that matter, extra baggage or check-in baggage. So everything, for everything else, you have to pay, right? So we believe that the mutual fund distributors, if they are adding value to the investors, in that case, investors will be willing to pay for that value addition in the long run. It's important how you structure, how you bundle it, and how you service the client. So combination of everything could help you. And if I give you one example, Zerodha is a broking firm which is charging for everything except a transaction, right? Earlier, and Zerodha is the firm which is making maximum profit among all the brokerages in India. So it's important that how you bundle, how you structure, customers will be willing to pay as long as you are adding value to the investor. Okay. So in the long run, what is good for the investor will definitely be better for the distributors as well.
Okay, Vivek and Rohit, I'm very curious to find out what percentage of your assets are passive? And did you, when you started talking passive to clients, did you face any kind of a resistance? And if you did face resistance, how did you overcome that?
So, see, I think we adopted a very simple approach. So what happened was that we were witnessing that the large cap funds were not able to really beat. And based on the asset allocation, we had a decent amount of the large cap fund exposure in each portfolio, depending on the asset allocation. One simple thing we did was to move that to index. That was the first step we took.
When did that start happening approximately?
It should be about 4 years now.
Okay.
Yeah. So we started adopting it. We started talking about it. Clients did ask a few questions. Why not this? Because those were popular funds having
Of
great
course.
brand names.
And they're popular fund managers also.
Popular fund managers also. Over a period of time, they accepted it because numbers don't lie, right? Finally, numbers, I mean, those are hard coded that way. So they started accepting that, yes, I think it is better that we move. So that was the first entry point into index funds, and then we started increasing it. Your question, what percentage we would have? Roughly about 15% of our total
1550?
15.
15. Okay.
15.
Okay.
15 will be in the indexes,
okay.
yeah.
Okay. Okay. And what about you, Rohit?
So we started this journey about 4 or 5 years ago, and I would say fairly aggressively. The incremental investments, I would say about 40% or even more would be going to passive. On the composition of existing portfolio, to be honest with you, I'm not ready for this exam. But I guess it is at least 30-35% already in passive, and it's changing very, very fast. It's changing very fast. For us, it's not about passive being cheaper. I think it's one of the way that you can work because it's simpler and it adds a lot of things in the way you manage the portfolios. The other thing which we also keep in mind that the amount of history that is available in passive. And if you look at some of the regulations, like I think by rules, the tracking error and related data is required only after 3 years. So, the kind of amount of data that you can analyze and look at, and, there is a randomness. So there is so much of the data that you can help to make decision. But it's like the more the option that you're available, the more data that you see, that more confidence that it gives you and the investor. So I think the change is happening very fast, but I would easily say more than 1/3 already in the passive.
Okay. Okay. One question that I wanted to ask Hari and you is that in an active fund, the fund manager concerned votes with his feet. If he likes the fund, if he likes the management, then, he stays in it. If he doesn't, he has the leeway to quit, right? As far as ESG and governance issues are concerned, where do passive funds, because they merely mimic the underlying index. And hence, how do they contribute to better governance? Because you are, by investing in the underlying index, you favor status quo. So whether the X company, which is a part of that index, uska management chore hai. Lekin you can't do anything about it because it's a part of the index. So how do you deal with this governance issue?
Yeah, so I think this is a very topical discussion about the role of passives.
Yeah.
And this taking place across the world as passives have grown. So the way I think about it is that there are, again, evolving thoughts about this. One school of thought is that, if you don't like the stock, management chore hai, for example, nikal jao, becho. Don't that stock which you don't like, and particularly regarding ESG issues. The other school of thought is that buy the stock, influence the management through voting power. And so that is an activist position while owning the stock. Right? So even activist investors look to do that. They get into the stock and then try to influence the management. So I don't see a direct contradiction with even a passive fund or passive ownership and having an activist view on the way the stock should be managed.
Okay. Shravan, what would be you've been doing it for years now.
Right.
Yeah.
So I would say we are very serious about safeguarding investors' interests from longer-term wealth creation journey. And through our voice and votes, we keep raising our voices to the management. And in the sense, we have a clear, defined stewardship policy wherein through discussion with management and through voting power, we are taking care of governance issue of the companies that we are holding. Whether it's active or passive, it doesn't matter for us. Although one thing differentiate about passive is we can't sell. But apart from that, everything, whatever is possible, we are doing to influence the management and to improve the corporate governance policy. So let me give you global examples. So for example, in case of Vanguard, Vanguard is situated at a very small suburb of Philadelphia, right? And most of the investment bankers and CEOs are flying to meet Vanguard management to secure their votes, because it is very important, because they are the largest holder of most of the companies and they are able to influence. In fact, there is a joke around that Philadelphia airport is crowded with CEOs and bankers because they are flying to meet the Vanguard management in their private jets. So if you are having a clear governance policy, then you can definitely influence. Although in case of passive, we can't sell, but I believe that is a smaller part of the problem.
Okay. Okay, we've come to the end of our allotted time, but before we wind up, I would like each one of you to tell this audience on why they should deal with passives and how there's a business case behind it. Starting from you, yeah, Vivek.
So, see, I think my message will be very quick. All of you today have plastic cards, which is the debit or the credit card. So when the MasterCard or the Visa started this journey, just imagine they wanted a client who would hold a card like what you have in your wallet, and there has to be a merchant, okay? These were early days of Master and Visa card. Today, all of us have adopted it, right? And there are merchants also. So just imagine, we are in early days of passive, yeah? We are trying to figure out a way to convince ourselves first and then convince the clients. But believe me, in the next 10 years, which is 1 decade from here, right, the adoption will be phenomenal, okay? And I think that is a time when you look back, you should realize that I had taken right steps back in 2022, and that has helped me to propel my business, to improve perception, and to survive in the marketplace. That is extremely critical. So I think that's my message. Don't look at the remuneration per se. That is not going to lead to any answer. What you have to look at is at a holistic model. Look at a different industry, see what has happened, and then come back to this industry and ask this question. You will get your answers.
Good answer.
So I would say you should consider wealth management as a supermarket, wherein you will have all kind of products which are adding value to the investors. And as long as you are adding value to the investors, definitely in the long run, you will be rewarded. So for example, as I mentioned, passives can be used for new client acquisition because the new age investors are looking at simple solution at very low cost, right? So from overall wealth management perspective, as it is very important that what is good for customer perspective. So you have to build client portfolio based on what is good for that particular customer, be it active or passive. And I believe that neither active nor passive could suffice the entire need of the customer. So you should bundle in a way that the overall portfolio can perform better, because in the long run, the distribution model is going to shift towards advisory module. That is going to happen sooner than later. And there are ways and means of making money. For example, plain vanilla index funds or ETFs are very attractive replies of 5-10 basis point. While some of the smart beta funds, there is scope to make money. So you have to structure your client's portfolio in such a way that the client's interest can be kept in mind. At the same time, you are able to generate a decent profit out of it.
So balance client interest and your own interest. Okay. Okay, Rohit?
Sure. So to extend what Shravan was saying, if we look at it in terms of being client-centric, what does the client really need? It is believed that Jeff Bezos, he keeps one chair empty in all his meetings, and that empty chair represents the client. So maybe we all can, try and do that when we are taking decisions like active, passive. So maybe, think from the client point of view, what would help him to make his life simpler and kind of easier to manage, what will help you to make it clear. So keep an open mind, look at how the world is shaping, look at what works for you. End of the day, security selection is not everything. I think we are all here to manage behavior. So what will help you to do better is what we all have to think about.
I think the perspective is that we are at a very, very early stage of mutual fund adoption itself in India, and that runway over the next 2 decades is going to, and the growth is going to be phenomenal. So the larger picture is that. And as we start today, let's take today as a starting point for that explosive growth which we'll see in the next 2 decades. We need to think about, as each of the participants have mentioned here, about what the customers eventually will require in their journey over this period. I think passives will play a key part in that entire portfolio which you will be constructing for your customers and your clients. And that's what I would like to leave with. This is something which passives is new in India. Mutual funds itself, in the larger context of it, is new. So passives can be a larger part of the portfolio as it is constructed, and the customers will benefit from that as well.
Okay. With that, we've come to the end of this panel discussion. I'll take one question if anyone has to ask. Wouldn't you like to ask this panel a question? Okay, if there's no questions, there's nothing holding back from us from lunch. So, Kavya, come and do the necessary announcement.
Thank you. Thank you so much, Prem. First up, can we have a huge round of applause to thank all of our speakers? And Prem, if I may request you to please do the honors of presenting a token of gratitude to all of your panelists as well.
Okay.
There's a all right. I believe there is a question, Prem, so shall we take that?
Okay.
All right.
If it is possible, why don't you show us one portfolio construction as an example for passive funds, which has given good returns so far, just for the help for all of us as participants.
So my answer to that is perhaps that this is not the correct forum for that. I run Cafemutual. So what we could do is, with the help of Vivek or Rohit, create a fictitious portfolio and put it up for your consumption. Is that okay?
That's fine, sir.
Okay, thank you.